So thanks a lot for having included our paper. It's a pleasure to present it, and thanks a lot for being with us. The paper is joined with Marie Brière, who's I think also in the audience, and it's going to be about robo-advising. So as you know, there is a lot of interest in robo-advising nowadays, both in academia and in the industry. And the question that motivates our interest personally are the following. The first is whether automation improves financial decision. We know that households make mistakes. We know that there are problems with the traditional financial advice, and the question is whether automated advice can help improving financial decision. The second question is whether automation promotes financial inclusion. A lot of robo-advisors were introduced because they have low operating costs, so they can potentially reach people who have been traditionally excluded from wealth management services. So the question is whether automation can promote financial inclusion. And the third, and more broadly, is studying through robo-advising a little bit robo-human interaction. We think that financial advice is particularly interesting in this dimension because it's not only about performance when we go to the financial advisor. Alberto has a paper showing that other dimensions are important, acquiring peace of mind. For example, some people say going to the advisor is a little bit like going to the doctor. So there are issues of trust, which are very important. And there could be also issue about complementarity or not between robo and human advice. So let me jump directly in what we do in the paper. We exploit the introduction of a robo-advisor by large French asset manager on a set of employee saving plan. Okay, so this is the first important part of the analysis. We're gonna have a pretty broad sample, which includes a lot of small investors who have little experience in stock market investing and little access to financial advice. So it's a pretty useful sample if you want to think about financial inclusion. We are going to look at who takes up these services, trying to understand whether those who need the service the most are indeed those who are able to benefit the most from this service. We're going to look at the effect on attention to see whether people see the robo as a complement or not to their own attention or action on the portfolio. We're going to look at the effects on portfolio choices and returns, focusing, our main focus will be on the dynamics of investor portfolio, of what happens after investors have taken up the robo, and we'll try to say something about financial inclusion. There are a few papers out there. The literature is growing fast on robo-advising, and I have the pleasure. We have the pleasure to have in the audience at least two key authors in this literature. So Alberto and Francesca have written a key paper on robo-advise, and they've written a review. We are writing together. We are contributing together to a book which is forthcoming, and I hope it's going to be interesting. So let me not spend a lot of time on this. Just highlight a few distinctive features of what we do relative to this literature. The first is maybe more methodological. There are going to be a few specific features of the robo which allow us to use different sources of variation to exploit the knowledge that we have about the robo rules, to try to get into trying to identify the effect of robo on portfolio choices. And on the focus of the paper, I think we have two key features. One is that our sample includes investors with small portfolio. We want to try to say something about financial inclusion here. And the second is that a lot of as I said, a lot of the effects we're gonna highlight have an important dynamic dimension. Okay, so the dynamic part will turn out to be pretty important for us. So the data, to tell you a little bit more, this in employee saving plan, as a standard, employee each year receive a sum of money that they have to allocate between a menu of funds, which is proposed by the employer. And this investment tends to have a rather long horizon, typically is used to finance retirement. And the asset manager, together with the employer, have decided to propose a robo-advisor. And the robo is doing, some of the things the robo is doing are pretty standard. The robo will elicit information about you, essentially about your risk aversion, your financial knowledge, your horizon, and it will propose you an allocation. And if you, as an employee, if you accept the allocation, the robo will implement it for you. Then over time, you can change this allocation as you want. Basically, after you have taken up the robo, then you are free again to change your portfolio as you want. And if it turns out that your current allocation deviates too much from the allocation which was proposed by the robo, you will receive an email that tells you that indeed your portfolio is far away, and it proposes you to log in again to the website and rebalance your portfolio. But this is totally voluntary. You can do it or not. Okay, just to give you an example of the type of picture that you get if you get this robo. After you have answered the values question, the robo will tell you the type of investor that you are, between prudent or dynamic. So this investor was moderate, and it will propose you an allocation, which is the one here on the right, and it will compare the proposed allocation to the current allocation, which is this one on the left. And then you can click on the values item and get more information on the type of, or the exact name of the fund which are behind this broad classification. Okay, so potentially you could look at what the robo is proposing and replicate it yourself. Okay, that's going to be an important point. The robo, whatever the robo is doing, you could do it if you wanted yourself. And this is an example of the email proposing you, telling you that your current portfolio is far from the target, and inviting you to log into the website and rebalance your portfolio. So we are looking at people over time. The robo was proposed to the employers. So that was a decision between the asset manager and the employers, starting from September 2017. And we have monthly data for following people for about 1 year before the robo introduction to after 14 months after. And we have different sample of people. We have those who take the robo, which are about 15,000. And then we want to compare them to sample of people who did not take the robo. So these are people who were proposed the robo but decided not to take it. But we also have people who are not exposed to the robo. These are people which were working in firms which were not proposed this service. And then we have a pretty interesting sample of what we call robo-curious. So these are people who have answered the robo question, and maybe they got until here and see their profile according to the robo and the allocation proposed by the robo, but then they stopped the service. They didn't accept the service after all. Okay. So these are important because so these are useful for us because we can basically for this type of people we can simulate what the robo would have done had they taken the service. And for this investor, we have information on what they do with their portfolio, the return they get. We have some digital footprint, especially the time that they spend to follow their portfolio. And we also have data coming from the robo, telling for those who went through the survey, the profile that they were giving, the location that they were proposed, and so on, and the alerts that they get. We see different specification, but this is the main one. It's going to be a standard if and if, in which we can control for individual and time fixed effect. And we're going to compare those who, so changes in some outcome to those who take the robo, to changes in some outcome to a control group. And in most of the, in the baseline analysis, the control group are going to be people who have not been exposed to the robo. And then I'm going to discuss towards the end the robustness of the finding when we control, when we vary this control group. We'll do quite a lot of robustness checks towards the end to try to address the fact that the decision to take up the robo is voluntary, and so it can be confounded by other factors. So first thing about to take up, who takes up the robo? I think the bottom line, if you want to take look at take up, in column 1 is that observable characteristics, apart from being female, do not have a strong impact on the probability to take up the robo. The fact that you see which are significant, are pretty small in magnitude, while the share of money that you give to the robo. So here the setting is one in which people can have different contracts and can choose to delegate to the robo just part of their financial wealth invested in the plan. So those who are, we see those who have lower financial wealth tend to delegate larger fraction of this wealth to the robo. And the third point is in column 3 and 4. Basically, the exercise we do is to ask whether, conditional on having expressed interest to the robo, say conditional on having been here and observing your current allocation and your what the robo is proposing, are you more likely to accept the robo when the robo is suggesting you to change a lot your portfolio or not? And the result we have is that when the robo is suggesting larger changes, people are more likely to take it. And this is interesting because this is pretty different from what we know with human advisor. Okay, we know that human advisor, on the contrary, tend to be pretty accommodating with their clients. Okay, so how do people change their activity once they take the robo? First thing we see is that people increase their attention when they take the robo. And this, importantly, this is true not only at the time of the subscription of the robo, which is mechanical, but also later on. Okay, so typically people will then pay attention again to their portfolio, either when they get money to invest again in the plan, or when there are big shocks. And we observe that in this situation, those who take the robo are even more attentive than the rest of the investors. Okay, so there is a persistent increase in attention. There are also more trading activities, and again, part of it is just mechanical. But you see in column 2, when you just look at activities which occur after the subscription of the robo, those who take the robo still trade more. And in column 6, you see they also invest more in the plan. Okay. Third thing, those who take the robo increase their exposure to equity. So basically what the robo is inducing is to decrease people's exposure to bond and to money market fund, and increase their exposure to balanced fund, which are partly of an equity component, and so overall the equity exposure of this investor increase. And you can do this in diff and diff as we are doing it now, but you can also exploit the algorithm of the robo. So the robo, the way is working is that giving your answer is giving you a score, and then there are cutoffs on this score. So suppose the score is between 0 and 10, and there is a cutoff at 2. That means that if you end up just before 2, you will you will be proposed an allocation, and just after 2, you will propose a different allocation. And there are several of these cutoffs, so we can do a standard regression discontinuity design. And basically, what you see in this table is that being allocated just, let's say, at the right of the cutoff, indeed increases the exposure to equity then relative to those who are allocated just below the cutoff. So this is indication that the result is driven by the robo algorithm, but this is not the only result. This is not the only effect on risk taking. Okay? There's an important part of risk taking which occurs over time, which occurs irrespective of whether you are at the right or at the left of the cutoff. And you can see it a little bit already in this figure. This time t is the time of the subscription of the robo. So there is an important jump in equity exposure when you take up the robo, but then you see an increasing trend also afterward. Okay, so this was I went pretty fast, but this is a little bit standard. I want to focus on something which I think is more original in our analysis, and it's the dynamic part. So we want to exploit the fact that the robo is sending alert to investor, and we want to study the reaction of investor to this alert for 2 reasons. One is because we know that rebalancing behavior are important determinant of the performance or the return that people experience in the stock market. And in particular, for less sophisticated investor, there is a typical problem, which is trying to time the market in the wrong way. Okay, so getting out from the market in bad times and investing a lot in good times, and this is quite bad for the performance. So we think that this could be potentially an important dimension that the robo can try to change. And the second one is that this helps shedding light on the dynamics of trust, or more generally of interaction between the robo and the investor, because this is a time in which the investor has experienced a little bit the service of the robo. There has been maybe a market shock, and the robo is recommending to do something without imposing to do something. And the investor has to decide whether to follow the robo or not at this period of time. Okay, so we think the response to these alerts are pretty useful. And here we can do 2 types of analysis. One is a diff and diff, comparing those who take the robo and those who observe the allocation which the robo is proposing without taking the robo. So these are the robo curious. And for them, we can construct the counterfactual alerts. We know what the robo would have sent had they taken the robo. And second, we can do here again a regression discontinuity design, because the alerts are sent if the distance between the current allocation and the target allocation exceeds some threshold. And so again, we can compare those who are just at the left and those who are just at the right of the threshold. The result we get are again consistent with the idea that the robo is inducing investor to change their rebalancing behavior in a way to stay closer to their target equity share. You you see this in the FinTech, you see this in the RDD. So this looks driven by the alert. Okay, we can do some placebo regression as well. Okay, and the effect is pretty big. The alert induced robot takers to decrease their distance by 4.8% more than curious. And this is big because the average change in the distance is 2.3%. So that's one important, I think, a novel aspect. The second is connected to returns. What happens to people who take up the robo? They experience larger returns. We know that some of it is driven by increase in risk that they take. Now, even if you control for risk, so you see that without controlling for risk, the increase in return is about 5.4% per year. Now, if you control for risk in various ways, that's between 3 and 4%. Now, we have a relatively short time period, and it's also maybe a particular period in which things were pretty good in the stock market. So I think it's particularly important that we try to understand what drives this change in return. Okay, so if you take, let's say, 3% increase in returns controlling for volatility, why is that robo-takers can have that? And there are essentially two ways in which robo-takers can have that. One is what we call a static effect. A static effect is what happens at the time of the subscription of the robo. Okay, suppose that you are choosing a point, a portfolio allocation which was not efficient, and the robo is bringing you in the efficient frontier. You can have an increase in expected return thanks to that. But there is also a dynamic effect, which occurs after the subscription. And this is driven by the fact that the robo might change the way in which you rebalance the portfolio. So the exercise is to take the total effect. Let's take this 3% effect and cut this effect into these two parts. So I made a graph to try to explain the way we do it. I hope that the graph is clear, or at least that you like it as a picture. So suppose that we are looking at let's say the equity share of an investor who's taking up the robo at time t star. Okay, so you have time here, and you have the equity share of the investor here. So this was the equity share before taking up the robo, and then this is an ideal case, but suppose that after the robo, the investor is jumping here and keeps the equity share constant over time. Now we want to check the effect on returns, distinguishing what happens by this jump from this jump, okay, which is the static effect. And this suppose that without the robo, the investor would have continued with this dotted line. Okay, so we want to distinguish the static effect, which is basically given by the difference between what we observe, what the robo would have done, so what the investor would have done without the robo, which is this line, and what the investor would have done if the investor had changed the portfolio allocation at time t star when it took the robo without changing the rebalancing behavior. So it would have had this red dotted line. So this is what we call a static effect, and the rest is the dynamic effect. Okay? Or alternatively, you can say, what is the intended dynamic effect? We know that the robo is essentially in this short period of time inducing, or would like to induce, constant portfolio weights. So if the robo were taking the current allocation as given and just changing the rebalancing behavior, you would start here. You would not change your current allocation, but you would change your rebalancing behavior. You would have this red line W dot star. So the intended dynamic effect would be the difference between this constant line and what you would have done without the robo, which is W0. Okay. So the idea is to cut the total effect into these two and see which one, so whether both matters or not. Okay. Let me skip the formula behind the graphs. The bottom line is, so take, for example, the total effect, which is 5.4%. The static effect accounts for about 2% of the total effect. And now we can compute it in a different way. It would count for 2.3%. Okay? Or you can put it differently. The total effect controlling for volatility is 3%. The static effect in column 2 and 5 is about 1%. Okay, so we can play a little bit with this specification and so on and so forth, but the bottom line is that an important part of the total effect on returns is driven by this dynamic effect, that is to say, is driven by the fact that people change the way in which they rebalance their portfolio. Okay, I don't know how much time I have. I lost track of time, Alberto, sorry.
3 more minutes or 2 more minutes.
Okay, great. So let me spend the last 2 minutes on two things. One is about inclusion. I promise this is one of the key questions that we have. So the way we do about inclusion is this is the first step, but is to check whether the results that we have are different depending on the baseline characteristics of investors in terms of wealth that they have, which we proxy by the amount of money that they invested in the plan, by the income that they have, which we proxy by the value of the remuneration that they receive within the plan, but also with respect to the baseline exposure to risk or to the baseline return that they were experiencing. And essentially, the picture we get overall is that our effects about increase in equity exposure and increase in returns are larger for those with lower assets to start with, lower income to start with, lower risk exposure to start with, and lower returns to start with. Okay? So you got an idea that at least in this case and in this sample, the robo was able to induce larger changes on smaller investors, on those who are less likely to participate in the stock market and to receive traditional advice. And so the increase in return, for example, was particularly positive for them. So we can also try to connect this to the debate about trends in wealth inequality and so on. Second thing I want to say before concluding is that, of course, a big sort of challenge here is that the decision to take up the robo is endogenous. And the way we try to address it so far was to exploit discontinuity in the algorithm of the robo, or to do standard if and if, comparing those who take the robo to those who have not been exposed to the robo. Now you can ask what happens if we compare the takers to other control groups, for example, to those who have been exposed to the robo but decided not to take up the service, or to those who have been curious, so those who have checked the profile and the recommendation of the robo but then decided not to take it. And this could try to isolate the effect of the robo, of the service of the robo in itself, as opposed to just observing what the robo will recommend. And I can tell you, barring these control groups, results are pretty stable. Okay. In fact, they are remarkably stable and do not depend on the control group, indicating that probably the variation we are using are really within as opposed to between groups. Another thing we can try to try to address selection is to exploit the fact that the fact of being exposed to the robo is a decision which does not depend on the employee. That was a decision taken by the asset manager and the employer. So it's probably orthogonal to any individual specific shock occurring for the employee. So we can do a standard intention to treat analysis, comparing those who have been exposed to those who have not been exposed. And we find results which are quite qualitatively very similar to the one we have seen. And the third point, which is pretty new, so I apologize if Francesco is not in the paper, is what if we look for sort of exogenous shock or possible exogenous shock to take up decision. And here, the idea we had was to think that maybe the take-up decision can be influenced by your colleagues. Maybe you hear in the corridor them talking about the service, and so you can get interested into it. And this, again, could be orthogonal to any individual specific shock. So we use, to instrument the take-up, we use the fraction of employee in the same firm who have taken up the service. And again, we find very, very consistent result using that. Okay. So let me not go through this result because of time. Let me just conclude. I think our main message is that the robo can promote financial inclusion. And that in order to understand the effect of the robo, it's important to take into account the effect on portfolio dynamics and more generally on human robo dynamics. Okay, what happens after the subscription in itself. Okay? This would open up a lot of additional questions that we have not addressed on the mechanism of increased trust or attention, or more generally on the human robo interaction. First and second, on what could be the long-term effect of the service or on this change in behavior, especially what happens in bad times. Okay, what happens if there's something like COVID comes, what happens in interaction with the robot. But I think I'm out of time, so let me stop here and thank you.
Thank you so much, Milo. The discussant is Francesco D'Appunto.
Great. So thank you very much. Thanks, Alberto, for asking me to discuss this great paper and Milo for the great presentation. And I always like to start my discussions with a summary of the paper in just one graph. And that's all I say about the summary. And that's the graph I picked in here in this case. So what we see here is over time, so around the time of adoption of the robo-advising tool, which is at time t, what is the equity share of those individuals that have taken the robo-advice afterwards relative to before? And I think, I mean, here we see kind of more or less already the basic sort of baseline results we have. So first of all, a crucial feature of adopting this robo-advising tool is that the equity share of these individuals increases substantially. I think this goes a bit also, by the way, to a question that Roxana was asking in the chat, in the sense of, so is this driven by diversification or concentration of risk? On the one hand, these people then increase their equity share, they're more exposed to risk. On the other hand, most of the products they obtain is based on funds and very diversified instruments that diversify within the same equity share. And also what we see here, I think very well, is what Milo was suggesting towards the very end. So there is both a static effect, meaning a huge jump, a big jump, at least in the raw data here. The estimates a bit of a different story, but a big one at impact, and then also a dynamic effect over time. Now, we saw that in the estimates, the relative size of the two seems to flip. But more or less what we want to understand, what we want to learn here is that the effects are not only statically at the impact. So this increase in the equity share translates into better performance in terms of risk-adjusted returns over the period that the authors observe, especially for what I would call the less sophisticated investors. So those that have smaller accounts, the smaller money invested, and so on and so forth. And also the authors find that several proxies for attention to the portfolio increase with adoption of robo-advising. Now, in terms of like the general assessment, I really like, obviously, you know, as you could imagine, the paper a lot. I really like this literature and understanding this topic of robo-advising much better. I think some of the features that the authors could push a bit more, I believe, relative to what they're seeing right now is, first of all, this is really one of the very first kind of studies that doesn't merely study the effects of what we call robo-managers. So in automatic algorithms, whereby once you adopt this algorithm, everything is done by the algorithm for you. So you don't have to make any other decisions going forward, which is what typically the media and normal parlance, for instance, in the US called robo-advising, but it's not really a true robo-advising. It's literally managing an account. Now, a true robo-advisor would be similar to what the authors study, what even with Alberto we studied in earlier settings, a situation in which the algorithm provides you with suggestions, but the decision-making authority stays with the investor. So why is this an important difference, I believe? Because especially for us as researchers, it's only the robo-advising setting that allows us to think about how humans interact with this machine, how do we understand different features of human behavior as they might be corrected or enhanced by the machine. So we cannot do that with a robo-manager, which is plainly giving you an allocation and doing everything for you. Other things that I believe are really unique about the paper is the setting of retirement savings. I will say a bit more about that later, because I think even here there's more that the author can push in this dimension. And also a great way to assess the selection issue, which always happens when we think about adoption of these techniques, in particular the difference between takers and couriers, of which I will talk also a bit more later, which I really like a lot. In general, I mean, I think this is extremely interesting evidence, and the execution is very reliable, as we saw also with Milo, a lot of tests. So this is definitely a great paper to think about. Now, in terms of my comments, I would like very briefly, sort of given we are in a few sessions, especially in this conference, a lot of people interested in FinTech research, how should this paper, I think, place in the FinTech literature more broadly. And then I will focus a bit on the attention results, which I think are definitely among the new ones in this paper. As I mentioned earlier, the retirement savings setting, where I think the authors can do a bit more. And then finally, something about this last selection point. So in terms of like placing the paper in the literature then, so a question that I myself have been asked over the last few years when presenting FinTech papers is, what is really FinTech? So should we think about FinTech research as being about any type of technology applied to finance, say ATMs, digital payments, and so on and so forth. And so something that with the survey that we have in progress with Sang Min Oh, a great PhD student at Chicago, we are trying to suggest in order to organize this research is that what we believe is the true crucial feature of FinTech work is that it relates to big and open data in finance. So the reason why we have only had FinTech research over the last few years and not earlier than that is that only over the last few years we finally have access to big and open data in finance that we can study both empirically and through theoretical schemes. And so when we think in particular about the four broader area of FinTech research under this lens, here we have something that we call the four FinTech, a ring of FinTech research. So the top left one, the blue one, is the set of papers that use existing empirical methods to study big and open data in finance. For instance, machine learning, reach, lasso regression, and so on and so forth. Alberto, for instance, has done work on that area. The green one would be new empirical and theoretical paradigms that have only started because of the new structure of this big and open data, for instance, primarily blockchain technology, and anything related to that. And then the second set of rings is what relates more, I think, to the paper today. So the red ring suggests, like, how can we use these big and open data that are now available both to algorithms and to providers to give advice to individual decision makers, and in particular to individual investors that typically are non-experts, exactly like the ones that Milo and Marie are studying in their paper. So robo-advising, income aggregators, and any form of applications in finance. There's also a smaller and also nascent branch, I think, of this literature that actually uses these apps and these FinTech applications to elicit, to obtain additional information about individual decision makers that normally would have never been available in observational data, such as their preferences, their beliefs, their perceptions, which also enhance our understanding of human decision making in general, above and beyond the robo-advising application. So I really think, thinking about this bigger framework, then this is a very strong, interesting contribution to the red ring of FinTech. So how can we use this big data through algorithms to provide advice and interact with individual decision makers? Now, the second point I wanted to make relates mainly to the attention evidence, because I think this is one of the totally new pieces of evidence we have in the paper. So far, for at least my reading, then Milo will tell us if I'm wrong, but it seems like the paper seems to imply kind of a chain of results in what happens here. So households, individual investors adopt the robo-advisor, they put more attention to think about their portfolio, and through this higher attention, they invest more in equity instruments, they have better performance, and so on and so forth. Now, I believe that, so one thing, for instance, if I had to really do the devil's advocate, that I wasn't fully convinced, at least of the paper as of now, is whether this really is some kind of chain results or actions that are connected to each other. In particular, what should we make about this result of the effects of robo-adoption on the measures of attention? And so to think about these results on attention, you know, I will refer to a paper by Alberto, not because it's the session chair, but just it's because it's the paper I know a bit better, having talked to him many times about this work. And so when we think about how people, how individual investors spend attention to their online investments. So here, this is a picture, a heat map I take from this paper that Alberto has with Antonio Gargano and the RFS, that's a pay-to-pay attention. So what's the idea of this heat map? Well, we are sorting, they are sorting, I should say, on the x-axis, all the different days of trading over a certain period of time. And on the y-axis, we have different accounts of a brokerage house, so individual investors. And these individual investors are ranked based on those that have most activity on the platform in blue. So those that are logging in and observing pages and so on and so forth, down towards the ones in yellow, which don't log in or pay any time in the platform at all. So we can think about the blue here as meaning that that person has logged in a certain day. And so then when we think about this type of data sets, I believe, so we already see kind of in the onset here that the largest sources of variation in attention are the cross-sectional variation. So there is a small bunch of people that always pay a lot of attention to their accounts. They log in every single day. This would be the people at the very top. And a huge bunch of people that maybe started an account at some point in time and never show up anymore. This would be all these people that are completely yellow down here. And also a lot of time series variations. So there are some periods in the year in which a lot of people among those that pay attention log in. And we can see also here, there are a few of these lines that are like repeated logging in every day over a certain period of time, as if, you know, in certain times of the year, potentially because of the business cycle, because of something that happens in the stock market, the same individual pays a lot of attention for a certain period of time, then they stop paying attention and they start again. So I think, you know, a crucially very interesting feature I believe the paper does and has, given the granularity of their setting, is that they can absorb both of these major sources of attention variation, both the cross-sectional one through the individual investors' fixed effects and the time series kind of general business cycle shocks one with the time fixed effects. So I believe that then I completely agree that the paper can sort of absorb most of these variations that we would be concerned about when interpreting attention results. Now, the part I think that is a bit trickier is the fact that still also in this same paper, and this is at least my reading of that paper, so we will see if Alberto doesn't agree later, but my reading of that paper is that actually a lot of times when the data seem to suggest that a person is paying attention to their account, that's actually not really necessarily what we would call paying active attention. So here I'm showing you, again, something from that paper where we have different timestamps based on the second, the URL that the individual investor was looking at that point, and how long the duration they've been on that URL. And so what we can see here, you know, sometimes they look at the home page, the balances and positions, and so on and so forth. But then what seems to happen is, first of all, often in this type of accounts, whenever there is an automatic refresh of the page, this could be counted as if the person is looking again at a new page, which would increase the measure of attention, but that's, you know, just mechanical. After I started to be there once, that seems to be what happens. Second, also, these individuals move back and forth across the same pages, balances, watch list, balances, and so on and so forth. So which even there would suggest that potentially for those people that log in at all at some point in time, we might have a sort of a mechanical increase in many of these measures, the number of pages viewed, the duration the person is logged in, just you know, mechanical, because the page was kept open, it was refreshing, and so on and so forth. So I think that, so what I would push the authors to do, because I think this attention evidence is really extremely interesting. I'd never seen, honestly, in some of the robo-advising papers I saw so far, evidence on attention in the context of robo-advising. Is first of all, one analysis would be what I call here a matching in time diff in diff. So what's the idea? If they observe it, because I'm not sure, I wasn't completely sure from the paper, but if they observe the timestamps, at least of when people log in into the account, they could actually repeat their matching procedures across the different groups, but based on the specific time of logging in. So comparing people that tend to log in at similar points in time, of course, not necessarily the same minute, but you know, more or less the same on the same day, some of which have the robo-advising tool and some of whom don't have the robo-advising tool. And so this would allow to think about then both the number the amount of time people spend on the portfolio condition on logging in, but also the other important new results. So whether they're more likely to rebalance relative to other people that have also logged in at the same point in time, as well as the different diffs of the performance. So I believe this type of matching procedure here would kind of purge some of those features of attention we mentioned earlier. Now, a second even analysis that I think would be very interesting and complementary to what the authors saw right now is to what extent are some of these results not driven automatically, you know, I wouldn't call it mechanically, but let's say mechanically because of the alerts. So we know, Milo said, these people get the alerts, many of them then log in and decide to change their composition. So I don't agree if people say this is mechanical, because again, in this setting, the investor can always decide to do nothing. So it's not really mechanical. They've made a clear decision that they want to change. So what would be mechanical is the robo-manager that I mentioned earlier. So there's still an active choice here. But I mean, it would be interesting, of course, to also understand as a complementary analysis, do some of these people, after they start to learn, the ones their actual positions go farther away from the target, do they learn themselves that they should go back and adjust their position? So is there a learning kind of a function, an educational function of the robo-advisor above and beyond just every time sending the alerts? They don't wait potentially more. So why is this important? I think this is very important because there's a big open question, I believe, at least in robo-advisor, that's what with Alberto we claim in one of our surveys, a big open question in trying to understand who benefits more from robo-advisors. Is it people that are already savvy, or people that here, you know, I'm exaggeratingly calling dumb, but potentially people who don't know what they're doing. So if we think that there is an educational role, then we might observe this, what I'm calling here dumb. So people maybe they were never logging in, that finally understand, you know, I should log in, I should adjust my account. I think that would be very interesting evidence that the paper can provide. Now, the third point I wanted to make regards the specific setting, which is retirement savings. And so I think that the authors so far don't push this point enough, honestly. So to the best of my knowledge, I would really say that this is the first time we can think about an actual retirement savings situation with robo-advising application, which is not a robo-manager. And so the reason why I think this provides an additional layer of analysis is that in the context of retirement savings, we have a very natural sort of benchmark comparison for robo-advising, which is target date funds or TDFs. So what's the idea of targeted funds? Well, actually, I think we could argue that targeted funds are some kind of a rudimental first version of robo-advising, in the sense that they automatically rebalance the combination of funds people have over their life cycle as they get closer to retirement. Now, I was, you know, when I prepared the discussion, wondering, do these TDFs exist also in France, given that France is the setting the authors have? I mean, at least I could find very briefly some evidence that exists. I don't know, because this is the, you know, I don't know what provider the authors have. So maybe actually their company doesn't have that. But, you know, I saw this thing on a page of Fidelity France, which I'm not even sure if that's the same Fidelity in the US because they have a different logo. But that's exactly the idea of TDFs. So you get a fund which has a certain horizon for retirement. And so the equity share is very, very large at the very beginning. So as you are very far from retirement horizons, and it declines automatically over time as you get closer and closer to the retirement age. Now here, they showed this in the kind of term structure. So this would be different people that have different products that finish at different points in time. So why is like the TDF benchmark, I think, very interesting? Well, it actually, given that this does have automatic rebalancing, it would be very interesting to understand if robo-advised clients do even better than those that have automatic rebalancing. And I think this is important, and again, can only be done here because TDFs only exist in the retirement setting. It's important because it gets back to this question of robo-advising versus robo-manager. So the TDF is similar to robo-manager, like Vanguard PAS and so on. So it automatically does everything. You don't have to touch it. So that's the active robo-advising suggestion, and an involvement of the individual actually potentially improve their performance, maybe because they put more attention to that, which is what the author suggests. Whereas the idea of the TDFs is exactly the opposite. So you should forget about your accounts and they go in autopilot. Now, it's also important for policy reasons because, of course, you know, the fees of these two different types of products are very different. Now, especially for the case of TDFs, what I could find in the same kind of brochure somehow of Fidelity is that the fees, the annual fees are pretty large, even for these TDFs that are completely automated, basically. So there's really no active management. You can see the fees up to 1.5% every year, which are more similar to an actively managed fund for what you would find in the US. So, you know, if the robo-advisor has a much lower fee, there would be welfare implications for sure. And so very finally then, because I don't think I have much time left, but so the very last point I wanted to make, I really like a lot, one of the specific comparisons in terms of selections the authors do, which I think also is quite unique for what I could say of this paper, which is the comparison between takers and couriers. So the idea of the couriers, as Milo said, is like people that have actually started the process of opening the robo-advising tool, but then for whatever reason they decided to not do that anymore. Because I really think here, as they suggest in the paper, I agree, you can really at the very minimum eliminate this layer of selection that we only see people that potentially for other individual time varying shocks have decided to start the account. Now, something that I would though push the authors to try to think a bit more is that, you know, what they propose as a feature, so the fact that the results for comparing takers with the couriers people are very similar to comparing the takers to those that are not exposed at all. So I agree that's a feature if we think the problem is the selection into the robo-advising. But also something that then opens up a question is surprising is that, so why is it the case that these curious people still don't do better than those that are not exposed at all? So currently what the paper suggests, you know, of course, it's very hard to test for any of that, but what the paper seems to suggest is that, you know, takers maybe are very close to their optimal suggested strategy by the robo-advisor. So they feel like, why should I pay any amount to just make a small change? But in fact, exposed, we see that the changes are pretty substantial, exactly because they also do much worse relatively to the takers, similar to those that were not exposed at all. And so, you know, ultimately, what are these curious people then doing? Is this a mistake that they're doing? So they believe that they will not actually obtain enough money for what they're paying if they start with this service? Or is actually the improvement that would be implied for these takers indeed pretty small? So are they right in thinking that this doesn't make sense? I believe that studying this segment more would be particularly interesting, again, when we want to think about it in terms of policy implications. Who should we propose these robo-advising tools? Can we use like the current positions, for instance, to think about who would benefit more or less? And so the final thing I wanted to just throw in there, a few open questions, I believe, for us all in the literature that come up of the paper. So first of all, so the take-up of this robo-advisory was extremely low, I thought, in the sense that, you know, we have at least like more than 600,000 of these private companies' employees that were sort of proposed, or I mean, those companies were involved in potentially using this robo-advisor. Of these, about 190,000 actually show some interest. This would include the couriers and the takers. And of these, it seems like only 15,000 finally decided to go through with the project. So I believe, I mean, understanding the motivations for the take-up, and in particular, in this case, also the motivation for this big drop at this stage. So those interested versus those that actively take up the investment. So would be extremely interesting to think about the motivations for robo-advising. Also, is this kind of evidence, if you want, in terms of the terminology of Gianaioli and others, is this evidence against money doctors? So the idea of the money doctors that literature has is that the only reason why people decide to take up risk, so they increase their equity share, is that there is a human they can talk to, whom they can blame, potentially for having suggested them to take this risk.
We have to wrap up because we are out of time, Francesco.
Oh, okay. Well, I know I didn't hear anything, so I was just proceeding. Fine, perfect. So let's, this is all things that are not particularly relevant. So let me conclude. I mean, great paper. Thanks a lot for asking me to discuss it. I think, I mean, there's quite a few things that would be very interesting to know even more about this setting. Thanks.